So now we want to look at the closing process. This is the finalization of the accounting cycle. So we started with journal entries, we recorded them in the journal, then we took them and posted them to the general ledger. We balanced the accounts, and from those balances we brought the account balances into the unadjusted trial balance. Then we looked at all of the internal transactions that took place within the company that we needed to bring up to date, and we made adjusting journal entries based upon the amounts in the unadjusted trial balance. We made adjusting journal entries, posted them to the general ledger, took those balances and brought them to the adjusted trial balance. From the adjusted trial balance, the financial statements are prepared because the adjusted trial balance means that the books have been completely brought up to date. Now we have to close out the books and reset them for the upcoming month. The following is the chapter example from Chapter 4 depicting the accounting cycle from the adjusted trial balance to the post-closing trial balance. This is our adjusted trial balance. Now we will need to prepare the closing entries and book them to the general ledger in order to close out the income statement accounts, which means all of revenue and income must be reduced to zero to reset this. Remember, the income statement accounts is comprised of the income or revenue and expenses. And since it's for the period ended, whether it's a month, a quarter, or a year, for the period ended, it only captures information for that period. Once the period has closed, then they must be reset to zero in order to capture information for the upcoming period, whether it be a month, a quarter, or a year. The same holds true for the dividends. The statement of retained earnings is only for a period of time, just like the income statement, and so dividends must be reduced to zero. So we'll use closing entries in order to close out the dividends account, the revenue account, and all of the expense accounts. So what do these journal entries look like? They are the same always. First, we take the revenue. Since it is generally credit-based, now we're going to debit all of the revenue accounts in order to reduce them to zero, and we're going to use an account to help collect this data called the income summary. We're not going to book these directly to retained earnings because it muddies the water when you try to look at retained earnings with all of these transactions going in and out. And accountants, as well as those reviewing retained earnings that are outside entities, prefer that the retained earnings account be more clean and understandable. So we're going to use an account that we just used during the closing process called the income summary account in order to help us book these transactions and reset, in this instance, revenue down to zero. And we will use the same account when we reset the expenses down to zero. So the first step is debit all of the revenue accounts. The second step will be to credit all of the expense accounts. Remember, expense accounts are debit-based. When we increase an expense account, its normal balance is a debit balance. So now, in order to zero them out, we are going to credit all of the expense accounts, and we will debit income summary. So income summary now will have a credit of $17,500 and a debit of $8,850. The next step will be to close out the income summary account to retained earnings. So it is just one amount from the income summary that will be booked to retained earnings. This will be the income summary, which we are going to debit, and I'll show you when we look at the TAccounts how you can understand that more clearly by looking at that illustration. And we're going to credit retained earnings for $8,650. Now, if you think about it, this represents net income because it will have been revenues minus expenses looking at the T account, and it'll be more illustrated when we look at these journal entries in relationship to the T accounts. But I'm bringing this to your attention so that when I show it to you again, you'll be hearing it for the second time. Next, we want to close out the dividend account. So we closed out the revenue and the expense accounts. So now we want to close out the dividends accounts, and we're going to also close that out to retained earnings. Now, if you look at this, this is beginning to look a lot like the pieces of the statement of retained earnings. So here we have retained earnings. We are going to debit it. Since dividends is a debit-based account, we're going to credit dividends in order to zero it out. So now let's see how these look in relationship to the TAccounts. Now, I will caution you when answering questions for both your homework and your test to go ahead and prepare the journal entries, but at the very least, prepare TAccounts for retained earnings, the income summary, and the dividends. And if you want to do all of these too as well, in an extra abundance of caution, do that. But that way you won't get turned around in this process. So let's look at the TAccounts. We had revenue. We had a beginning balance in revenue of $17,500. By preparing this closing entry of $17,500, I now see that my debits equal my credits. When the debits equal the credits, that means that there's a zero balance. Next, we can see that we've cleared this out, and now we've credited it to income summary. So income summary will have a closing entry of $17,500. Next, we will use the income summary account, and we will credit all of the expense accounts in order to zero them out. So we're going to credit rent expense, salary expense, utilities expense, supply expense, depreciation expense for the furniture, and depreciation expense for the building. Again, if I'm moving too fast, pause it and look at it, and then pick it back up again. And we see that there is a closing entry to the income summary of a debit. Now, taking our debits, adding up all of our debits and adding up all of our credits, taking the smaller from the larger, we can see that now in the income summary account there's a balance of $8,650, which if you were to prepare an income statement, which would be revenue minus expenses, you would see that this would be net income. Now let's look at our third entry. Now we're going to close out the income summary because it's just associated with the income statement accounts. We're going to close out the income summary to retained earnings. So now retained earnings will have a credit of $8,650. Income summary will have a debit of $8,650. So this was our ending balance. We add up all of our debits, add up all of our credits. We'll have a zero balance now. Don't get confused between the closing entries and the balance. The balance here represents all of the closing entries, so that's the ending balance. We have a new entry, so look at this piece of it when you're considering what will be your ending balance and that the income summary has been zeroed out. Our last one is to close out dividends. And so we're going to close out dividends to retained earnings and credit dividends in order to zero it out. So we had a beginning balance of $5,000, a closing entry of a credit of $5,000. Now this means that dividends are zero. We're going to use this closing entry and post it to the retained earnings account as a debit, which means that the ending balance in retained earnings will be $3,650. So now let's look at all of these amounts in relationship to the post-closing trial balance. We see that our retained earnings account has a balance for the first time since this was a startup company, didn't have any beginning retained earnings. So now we see our retained earnings account now reflects $3,650. We see that there's no balance in dividends because it's been closed out, the same for revenue, and the same for all of these expenses. They have all been closed out. So the only thing that remains on a post-closing trial balance will be those accounts associated with the balance sheet. Remember, the balance sheet has permanent accounts because the cash will still exist at month end, even though we're in a new financial statement period. The same as supplies, they will still exist. Accounts receivable, prepaids, accumulated depreciation, land, all of these accounts will still exist. The only things that are zeroed out and represent the just closing last period are the dividends, the revenues, and expenses, so those are only accumulated for a period of time, closed out to the permanent account, retained earnings.